Welcome back to the deep dive. We're moving beyond the surface level reports and really stripping away the noise to find the core knowledge that truly matters. Today, we are stepping into the deep end of the semiconductor world, specifically semiconductor intellectual property, or SIP.
Right. This is the hidden wiring. It powers, well, every modern device, from your smartest wearable to the brain of a self-driving car.
And our central high-stakes question today isn't about the giants, the NVIDIAs or the TSMCs. It's about the specialized architects.
Exactly.
Is the edge AI revolution this necessary shift where computing power moves from the massive cloud centers to every tiny device? Is that real? Or is it just the latest marketing buzzword designed to, inflate valuations?
And more importantly.
More importantly, can a small specialized IP firm called CEVA successfully tax every single device that joins this technological tidal wave?
That's the question.
We are conducting a thorough deep dive into CEVA, Inc., ticker CEVA. And here is the initial takeaway. Our intrinsic valuation suggests this stock, currently trading right around $22.90, is doing so with a significant margin of safety.
A big one.
If their core thesis that they will be the essential intel inside of the proliferating edge AI era, if that plays out, this presents an incredibly attractive asymmetric bet.
It does.
So our mission is to analyze the business model, dissect the management strategy, and determine the true financial value that warrants that valuation range.
And this is a truly pivotal moment to analyze CEV, Inc. Today is December 10th, 2025.
Right.
I mean, this company has a deep legacy. It was built over decades as a licensor of digital signal processors, or DSPs.
And those handle things like audio, radar, imaging.
All that stuff. But that legacy is now aggressively colliding with the future. A necessary full-scale pivot toward neural processing units, NPUs, and what the industry correctly labels physical AI.
Okay.
So we need to determine through the numbers and the technology whether CEV is merely a resilient survivor of the mobile era, clinging to old revenue, or if they have successfully architected their future as the essential IP provider for the explosive IoT and automotive growth markets.
We have a lot of ground to cover to answer that. Let's make sure we move logically through the evidence. Part 1, chapters 1 to 3, business, management, and financials. Chapter 1, business understanding.
Chapter 1, business understanding. The first thing you must understand about CEVA is their core identity. They are the silent architect.
They don't make chips.
They do not manufacture chips. They don't own fabs. They are not sensitive to, concrete or physical supply chain disruptions in the same way manufacturer is. Their entire operation is based on the ECP licensing model.
Semiconductor intellectual property.
Right. They sell blueprints.
And that model is the foundational engine that drives everything else, particularly those fantastic margins we are definitely going to get to later.
Oh, yeah.
They're selling complex engineering solutions, not physical widgets.
Right. It's the closest thing to a software business that exists in the hardware world.
And the closest analog is, of course, the giant ARM holdings.
Of course.
But CEVA is focusing on that niche, highly specialized signal processing, the DSP, and integrating AI capabilities into those specific processors.
Exactly. It's the ultimate design once, license many engine. Think of the R&D. They spend immense sums, millions of dollars, thousands of engineering hours to create the perfect, most power-efficient standard.
Like a Wi-Fi 7 stack or something.
Or a specific low-power AI processor like Nupro Nano. Once that design is silicon-proven and error-free, they can sell the right to use that blueprint hundreds of times over to different chip manufacturers globally.
Okay.
And this strategy generates two highly distinct but necessary revenue streams.
Which tell the market two very different stories about the company's health. Let's start with the immediate revenue, what we can call the hunter.
The hunter is the licensing fee. This is upfront cash, non-recurring, and it's the leading indicator of the company's future health and market traction.
So a customer like, let's say, Microchip, who we'll talk about.
A major industrial chip designer like Microchip, or an automotive startup, they want to add a complex feature, say, ultra-wideband tracking or advanced AI inference capabilities to their new silicon.
Right.
So they pay CEV a substantial, often multi-million-dollar lump sum for the right to use that IP design.
And in Q3 2025, this licensing stream was pretty strong.
Very strong. It totaled $16 million, representing a healthy 56% of their total revenue. This figure shows that management can sell the technology today for designs that will be manufactured years down the line.
And then the critical stream, the long-term annuity, we're calling the farmer.
The farmer is royalties. This is the pure, high-margin profit that flows in years later.
So once that licensed chip design is actually manufactured in volume.
Every single time one of those chips is shipped in a car, an earbud, a fitness tracker, CEV collects a small pre-agreed fee per unit.
And this is almost pure profit.
It is nearly pure profit because the R&D cost to create the IP was already sunk, already paid for years earlier by that initial licensing fee.
Okay, so what was that number in Q3?
In Q3 2025, royalty revenue was $12.4 million, making up the remaining 44% of total revenue.
Right.
The health and growth rate of this 44% stream tells us how successfully they've managed to monetize past licensing deals in the real world.
Now let's pivot to the products, because CEVA is attempting a pretty dramatic shift from a legacy business to what we're calling the growth engine, Edge AI.
Yes.
Historically, their bread and butter has been wireless IoT, IP, Bluetooth, Wi-Fi 67, UWB, the standard connectivity backbone.
And we cannot underestimate the sheer scale of this foundation. I mean, it provides critical royalty stability.
What are we talking?
This legacy business is enormous. In Q3 2025 alone, CEV-powered units shipped globally reached a staggering 579 million units.
Wow.
To put that in perspective, that's roughly 6 million devices shipping every single day, relying on CEVA technology for their connectivity or sensor processing.
That is a massive, sticky, installed base that provides a lot of resilience.
A huge cushion.
But the future isn't about connectivity. It's about intelligence. The focus is squarely on the NuPro NPUs, the neural processing units, specifically the ultra-low power NuPro Nano family.
Right.
And this is the critical shift to physical AI. We need to elaborate on why running AI inference locally on the device, rather than, routing tons of data to the cloud, is the necessary future for IoT and automotive.
It's fundamentally a question of physics and economics. For battery-operated IoT devices, constant communication with the cloud is a death sentence for battery life.
Drains it instantly.
Instantly. By running AI inference locally, analyzing the image, the audio, or the radar data on the device, you save immense bandwidth and, crucially, battery power.
And for time-sensitive applications, like ADAS in a car.
Latency is lethal. You can't wait milliseconds for a cloud server to approve a braking maneuver. Local physical AI reduces latency to near zero.
And there's a privacy benefit, too.
And, as a bonus, it protects privacy. Because the raw sensor data, your audio stream, your video feed, it never leaves the device. That low-power local computability is exactly what the NuPro family is designed to provide.
Okay, so if this technology is so critical, why can't a major chip designer like an Intel or a big Asian fabless firm just build their own equivalent NPU? What is the competitive advantage? The moat that protects CEV's licensing premium?
Well, their value proposition is threefold: risk reduction, speed, and specialization.
Okay.
First, the risk. Designing a complex silicon-proven IP core takes, 18 to 24 months? It involves hundreds of engineers and millions of dollars.
And it's fraught with risk of costly silicon bugs.
Exactly. Licensing CEV allows a customer to bypass that massive R&D sink and dramatically accelerate their time to market. In the consumer electronics world, where product cycles are 6 months long, getting a chip out 18 months sooner is invaluable.
But the true technical moat where they differentiate from a giant like ARM lies in their specialized architecture. Sensor fusion. How does that integration actually work?
This is the crux of the bull case. CEVA's expertise isn't in general-purpose computing like a CPU. Their deep core competence is the DSP, the digital signal processor.
Which is designed specifically for messy, raw data from sensors.
Right. Radar, audio, LiDAR. The moat comes from integrating the NPU, the logic that interprets the sensor data via AI, directly into the complex DSP pipeline.
Okay, so what does that actually mean in practice?
It means the data stream doesn't have to leave the core, be cleaned, travel across the silicon bus, and then be read by a separate NPU core before the AI inference is run.
And that constant data transfer between different cores.
That's where the real latency and power waste occurs. That's what their competitors often require.
So CEVA has a single unified core that does both things.
A single, highly specialized, unified core architecture that handles raw sensor input and the AI interpretation seamlessly, making it exponentially more power and silicon efficient for edge applications than general-purpose solutions.
And once a customer integrates that specialized, power-efficient technology, they are functionally locked in, which secures that long-term royalty stream.
Precisely. This is the developer lock-in strategy at play. When a chip designer or system integrator commits to CEVA, Their engineers invest significant time learning the proprietary software toolchain,
The CDNN, right.
specifically the CEV Deep Neural Network Software, or CDNN. This software layer allows them to port and optimize their AI models to the CEVA hardware.
And that investment in time and training.
The investment in time, training, and specialized code makes the switching costs to a competitor, where they would have to entirely re-engineer their software stack, immense. It creates a deeply sticky ecosystem that stabilizes their future royalty payments.
Let's pull back and look at the broader market. The overall semiconductor IP market is forecast to grow pretty robustly, somewhere between, 7.8 and 9.9% CAGR?
That's the baseline, but CEV is focusing on the fastest-growing segment within that, Edge AI and IoT.
Right?
The pendulum is swinging hard away from massive generalized cloud AI toward localized, specialized physical AI.
Right.
We're moving toward a world where every car, security camera, and industrial robot needs instantaneous, low-power decision-making capability. This accelerating demand is the tide lifting all boats in the MPU space, and CEV is positioned with a specialized paddle.
Now for the competition. This landscape is a battleground. We have to address the overwhelming strategic challenge posed by ARM Holdings.
ARM is the definition of the gorilla in this room. They are the ubiquitous standard. Nearly every major chip designer uses ARM CPU cores.
And they're not just sitting back.
No. ARM's strategic move is to leverage this dominance by bundling their Ethos MPUs directly with their omnipresent Cortex CPU cores. This offers customers a simple, convenient, one-stop shop solution for processor IP.
And this is the single biggest threat to the CEVA bull case. How does CEVA overcome that enormous hurdle of just convenience?
It's a classic technological trade-off. ARM offers convenience. CEVA offers superiority in a narrow field.
So CEVA's challenge is to prove that their tech is so much better.
So fundamentally better in terms of power efficiency and silicon cost, that the customer is willing to actively break the convenient ARM bundle, deal with the licensing costs for a separate processor, and absorb the switching costs related to the software ecosystem.
That's a high bar.
If CEVA is only marginally better, ARM wins on convenience. If CEVA is dramatically better for the specific use case of physical AI, CEVA wins on efficiency.
We also have the enormous design giants encroaching.
Yes, Cadence and Synopsys. These are massive IP portfolio companies, often focusing on interface IP and design services, but they're increasingly encroaching on specialized processor IP.
And they have deep pockets.
Incredibly deep pockets, vast R&D budgets, and extensive, long-standing customer relationships that CEVA, as a smaller, highly focused entity, must constantly contend with.
And finally, the structural long-term threat, RISC-V.
The growth of RISC-V is a long-term deflationary cloud over the entire proprietary licensing industry. It's an open-source instruction set architecture offering a free alternative to proprietary cores like ARMs and CVAs.
So it's still maturing, but...
It is, especially in the complex NPU space. But its very existence threatens to undercut proprietary IP pricing across the board. It forces everyone, including CEV, to constantly justify their premium with unparalleled technical superiority. Otherwise, the customer can choose the good enough free alternative.
Before we move to management, we need to tie this back to the macro environment, specifically the geopolitical risk in late 2025.
The environment is incredibly complex. The U.S. government has been signaling aggressive tariffs, potentially 25% to 100% on semiconductor imports, in an attempt to push manufacturing back onto U.S. soil.
But CEV sells IP digitally, so they're tariff exempt, right?
The IP is, but their customers are the ones facing the tariffs.
So if these tariffs successfully disrupt the global supply chain, or if they just cause a major slowdown in the global chip market?
That directly impacts CEV's core annuity stream.
The farmer?
Precisely. CEV's royalty checks are tied directly to the number of physical units shipped by their customers globally. If the global production volume shrinks due to tariffs or trade wars, CEV's farmer revenue shrinks accordingly.
But on the other side of that coin...
On the other side, we should note the massive counterstimulus from the Cheap PS and Science Act, which funds domestic manufacturing, potentially stimulating demand for new, advanced chip designs within the U.S.
Which would be an immediate benefit to a U.S.-based IP provider like CEV.
Exactly. It's a very complicated hedge.
Chapter 2, Management Evaluation.
Chapter 2, Management Evaluation. The success of this pivot from DSP legacy to Edge AI depends entirely on the leadership. The current captain of the ship is CEO Amir Panush, appointed in January 2023.
So he's been there long enough for his strategy to take root and be measurable.
That's right.
And his primary strategy is clear, moving away from a general scattered shotgun approach to licensing.
towards securing strategic, high-value partnerships. He is focused on quality over quantity, trying to land those few massive deals that promise enormous long-tail royalty streams in the automotive and high-end industrial sectors.
And the execution track record in 2025 provides evidence that this strategy is, well, gaining traction.
It does. CEVA beat earnings expectations in both Q2 and Q3 of 2025. That consistency in operational outperformance is crucial.
Why so crucial?
It signals to the skeptical market that management has dramatically improved its control over operations, its pipeline visibility, and its ability to accurately forecast when those complex licensing deals will close and hit the revenue line.
Looking beyond execution, let's examine management's relationship with the market, specifically transparency, which can often be lacking in small-cap tech.
Their candor has been a notable strength. On the Q3 2025 earnings call, CFO Yaniv Arieli didn't shy away from the critical growth metric.
No, he didn't.
He explicitly detailed the revenue mix, confirming that AI licensing had grown to 1/3 of the total licensing business.
And for growth investors, that is the smoking gun.
It's hard, measurable evidence that the strategic pivot is translating into their P&L. This level of granularity builds trust and allows analysts to properly model the future.
Shifting to capital allocation, if you invest in CEVA, you are fundamentally investing in a highly specialized, advanced engineering firm.
The financial allocation confirms this identity. They are staggeringly R&D intensive.
How much are we talking?
In Q3 2025, they spent $19.5 million on R&D against $28.4 million in total revenue,
So that's almost 70% of revenue going right back into R&D.
a ratio of nearly 68%. That level of spending is necessary to keep their technical lead, specifically in the sensor fusion and NUPRO NPU space, against the bottomless pockets of rivals like Cadence and the market pressure from ARM.
The market also needs to see disciplined M&A, not just acquisition for growth's sake.
Their history shows discipline. They acquired a design services firm, Intrinsics, years ago. While it served a purpose, management later recognized that the services business was diluting the focus on their core high-margin IP licensing.
So they sold it.
They made the difficult, disciplined decision to sell the asset to Cadence. This act of reversing a strategic course demonstrates excellent capital stewardship, a willingness to pivot back to their high-margin core mission and not simply chase top-line growth at the expense of profitability.
How is management addressing shareholder returns, given the no-dividend policy?
Well, no dividend is the right policy for a high-growth, high R&D firm that needs every dollar to maintain its technological lead.
So they use buybacks.
Their primary mechanism for returning cash is buybacks. They repurchased about $1 million worth of stock in Q3 2025, totaling $7.2 million year-to-date.
It's not a massive program.
No, it's not aggressive, but it is a consistent signal that management believes the stock is fundamentally undervalued at the current levels, around $22.90. They're slowly, methodically shrinking the share count using excess operational cash.
Now we hit the crucial point for value investors, the investor's patience test. The return on invested capital, or ROIC.
The ROIC is the elephant in the room. It's currently reported at a very low 1.4%.
Which, for a business model that boasts 88% gross margins, an ROIC that low looks, frankly, abysmal. It signals poor capital efficiency.
It does, and that's usually a red flag.
But the context matters. The ROIC is low by design right now.
That's the key analytical insight. This metric is severely depressed by the heavy, necessary R&D burden, that $19.5 million expense every quarter.
So they're spending now for revenue later.
They are consuming capital and cash flow now to design the next generation of AI products like NUPRO Nano that will not generate meaningful royalty revenues until 2026, or more likely 2027. They're operating at a temporary financial disadvantage to secure a long-term technological lead.
So the key assumption embedded in the bull thesis is not that ROIC must stabilize, but that it must dramatically expand over the next 2 to 3 years.
Precisely. The investment thesis hinges on ROIC expansion. The moment those new high-margin royalty streams from the monetized AI products begin to flow into the financials, the ROIC should accelerate quickly.
Proving that R&D was a good investment.
Proving that the high R&D spend was a valuable investment, not merely an operational necessity. If we look out to 2027 and the ROIC remains near 1.4%, the entire investment thesis fails, because it means the AI pivot did not monetize successfully.
Chapter 3, Financial Health.
Chapter 3, Financial Health.
Let's contextualize the size of the company first. CEVA sits firmly in the small cap category, with a market capitalization fluctuating between, what, $552 million and $618 million.
Right.
This size automatically implies inherent stock volatility, but it also provides the potential for the outsized returns that we look for when a small, focused firm successfully scales its technology.
But the historical revenue story is the primary source of market skepticism. If you look at the 5-year trend, CEVA has struggled to break out of that $100 to $120 million annualized revenue range.
They peaked in 2022.
Peaked at $120.6 million in 2022, then endured a brutal 19.2% cyclical contraction in 2023. This history of stagnation and cyclicality is why the market is reluctant to assign them a high-growth multiple.
But the sequential momentum is the first sign of life the market has seen in years, right?
Absolutely. The year-over-year growth for the full year 2025 might only be modest, projected around 3 or 4%. But the sequential growth in Q3 2025 was a significant 11% increase over Q2.
And that pulse is the tangible evidence.
That 11% pulse is the tangible evidence that the AI licensing deals and the pivot strategy are finally translating into the P&L. It suggests the new growth engine is starting to warm up after years of being dormant.
Let's discuss the margins, which we call their financial superpower.
The gross margin is truly phenomenal. It's the software-like margin profile. Sits at 88% in Q3 2025, which is an increase from 85% year over year.
So that confirms extreme pricing power.
And exceptionally low COGS. The quality of their IP is non-disputable. However, the operational reality gets messy when you look lower down the income statement.
This is where we need to address the crucial difference between GAAP and non-GAAP profitability, a place where many retail investors misread small cap tech.
It is certain to understand this distinction. On a strict GAAP basis, CEVA reported a GAAP net loss of negative $2.5 million in Q3 2025.
Resulting in a negative operating margin.
Right. So on paper, it looks like a losing business that burned cash. But when we strip out non-cash expenses, primarily stock-based comp, which is equity used to pay employees, not physical cash, the story changes entirely.
And what's the non-GAAP number?
Non-GAAP operating income was positive at $3.1 million, resulting in an 11% operating margin.
So the business is operationally profitable, but the accounting loss is driven by the necessary cost of acquiring and retaining high-end engineering talent through equity grants.
Exactly. The real financial hurdle then is reaching consistent free cash flow generation.
And that's been volatile.
Volatile, as you would expect from a company in heavy transition. It has oscillated between barely positive, like $500,000 in 2022, and negative during the 2023 cyclical bust.
But Q3 was positive.
Crucially, Q3 2025 did generate positive operational cash flow, enough to fund their small buyback program. The takeaway is that CEVA is not yet a mature cash-gushing machine. It is a cash-consuming growth entity dedicated to funding the R&D pipeline that will eventually turn into royalties.
Now let's look at the balance sheet, which is arguably the strongest part of the entire financial profile.
It is a fortress. In a late 2025 environment where the 10-year Treasury yield is hovering around 4.14%, CEVA's near-zero debt status is a massive strategic advantage.
The debt to equity is tiny.
Negligible. 0.02. They have virtually zero interest expense, burdening the P&L, which is rare for a growth-focused company.
And their liquidity position borders on excessive.
The current ratio is a staggering 8.68. This means they have almost 9 times more liquid assets, cash, equivalents, and short-term receivables than they have in short-term liabilities.
So they're in zero danger of insolvency.
Zero. It provides a deep layer of Benjamin Graham-style downside protection. In fact, one could argue, and I often do, that management is potentially too conservative.
Sitting on over $150 million in cash.
Right. Instead of aggressively deploying it for either faster growth through larger engineering teams or significantly more aggressive share buybacks, given their belief in the stock's undervaluation.
That brings us directly to valuation. Since GAAP earnings are negative, traditional PE multiples are nearly useless for relative comparison. The price-to-sales ratio, sitting at around 5.09, is more telling.
Yeah, and if we compare that 5.09 PS ratio to high-growth semiconductor IP peers, who often trade between 6 and 10 times sales, CEVA is trading at a distinct discount.
A show-me story.
It's priced like a classic show-me story. The market is waiting for indisputable, consistent proof that the AI monetization will translate into sticky, massive royalty revenue before it grants them a higher growth multiple closer to their peers.
This is precisely why we rely on intrinsic valuation. Before we land on that final valuation, let's quickly refresh the key levers in our discounted cash flow model.
The DCF method, for all its complexity, is simple in principle. You estimate all the money the company will generate over the next decade and bring that value back to today.
But it's only as good as the assumptions you feed it.
And here, those assumptions rely heavily on the AI pivot succeeding.
What are the primary assumptions based on our source data?
Our base case assumes an aggressive but necessary 13% annualized revenue growth rate through 2026 and 2027. This 13% cannot be met by the legacy business. It has to be driven by new AI licensing and the subsequent royalty ramp-up.
Okay. What's the discount rate?
Our calculated discount rate, the WACC, which accounts for their volatility and current high interest rates, comes in at 9.04%.
And the most aggressive assumption?
The required margin expansion. We assume non-GAAP operating margins must climb from the current 11% to 20%, fueled by the high-margin royalty growth expected in the outer years of the model.
And when you run those inputs through the model, what is the estimated value range?
Under the base case scenario, where they successfully hit 13% growth and achieve that 20% margin expansion, the estimated fair value is $30 to $35 per share.
And the bear case?
Our bear case, which assumes the AI pivot stalls, forcing revenue growth back to mere inflation rates, say 3%, and margins remaining flat, lands the value closer to $18 to $20.
So with the stock currently trading at $22.90, the quantitative conclusion is that the stock is priced near the bottom of its fair value range.
It implies a strong margin of safety, particularly due to that $150 million cash pile. The market is effectively giving you downside protection around $20, while offering significant upside potential of 30 to 50% if the AI growth story materializes as management predicts.
Before we jump into part 2, let's take a quick moment for our consolidated call to action. If you are finding this level of deep dive analysis valuable, whether you're researching for an investment or just preparing for a complex meeting, we need your support. Please take a moment now, like and subscribe to Stock Analytics AI.
And for those who need this rigorous research across the entire market, we have an option for you.
For $4.99 a month, you can get access to over 500 deep dive videos on all S&P 500 stocks, with the NASDAQ 100 coming next. Plus, you can suggest members-only requested deep dives just like this one. Part 2, Chapters 4 to 7, Market Sentiment, Ownership, Risk, and Final Conclusion. Chapter 4, Market Sentiment.
Chapter 4, Market Sentiment. Market sentiment helps us understand whether we are early or late to the party. Wall Street consensus is currently Y to strong buy, signaling broad, albeit cautious, optimism about the turnaround.
But the analyst price targets are what we focus on.
Right.
The median price target is $32.47 with a bullish high of 42 and a crucial low target of 21.21.
And what's fascinating here is the narrow range of bearishness. Even the most bearish analysts, those projecting the $21 price target, see the stock as nearly fairly valued at the current price of $22.90.
So the consensus is projecting 40 to 50% upside.
Which, as we noted, aligns quite neatly with our own intrinsic valuation of $30 to $35. The street is waiting for the same proof we are, but they are generally optimistic.
What were the recent catalysts that led to this shift in sentiment?
Two main events. First, the Q3 2025 earnings beat was significant. They beat on EPS 11 cents versus the 10 cents expected, which resulted in a sharp 6.19% stock jump pre-market. That demonstrated execution.
But the bigger catalyst was microchip.
The more substantial validating catalyst was the announcement of the microchip partnership. Microchip is a major Tier 1 semiconductor company, and their decision to adopt CEVA's IP validated the technology and the strategic pivot. It shifted the market narrative from, can CEV execute a turnaround, to CEV is executing solid industry partnerships.
This brings us to a crucial and sometimes confusing market indicator: short interest. Sophisticated investors are currently betting against this company.
That's right. Short interest is high, sitting at 10.62% of the float as of late 2025, which translates to a significant 8.6 days to cover ratio.
So a substantial portion of professional investors are skeptical.
They're betting that the AI hype will not convert into sticky revenue, or they anticipate that ARM's bundling strategy will successfully freeze CEV out. They're essentially betting the bear case plays out.
But high short interest for the bullish investor is potential fuel.
It creates a coiled spring. If CEV posts another strong quarter in Q4, or if they announce another major Tier 1 automotive partnership in early 2026, those short sellers, those sophisticated investors who sold borrowed shares, will scramble to buy shares to cover their losing positions.
Which can lead to a powerful short
A
squeeze.
rapid, accelerated increase in the stock price. Exactly.
Technically, the stock momentum suggests that the accumulation has already begun.
The technical signals are bullish and aligned with the Q3 fundamental performance. The stock is trading above its 50-day moving average, a common momentum indicator.
And it bounced off its lows.
And it has established a clear higher low after bouncing powerfully off its 52-week lows, which were around 1823. The fact that the stock has gained 56% over the last 6 months suggests that smart money began accumulating shares in mid-2025, anticipating this exact AI turnaround that we are now seeing validated in the Q3 financials.
Chapter 5. Ownership structure.
Chapter 5. Ownership structure.
We established that this is a small-cap stock, but the ownership concentration is high. Institutional investors own roughly 77% of the company.
That high institutional ownership provides a baseline of stability. They're less likely to panic sell during minor volatility. However, it also means the stock is highly sensitive to large rebalancing events.
And the major passive owners are who you'd expect.
BlackRock holds 13.4%, and Vanguard holds 9.08%, simply tracking index funds.
But the presence of an active, contrarian investor is often a strong signal. Tell us about Sinvest Management.
Sinvest Management holds a notable 8.18% stake. Sinvest is known across the industry for its deep fundamental, value-oriented research. They are not momentum traders.
So their stake is a vote of confidence.
Their significant stake suggests they have done their homework and believe there is a deep value dislocation here, that the intrinsic value of CEVA, driven by the AI pivot, far exceeds the current market price of $22.90. This provides a measure of external validation for the bull case.
How about internal players? Insider ownership is relatively low, around 2.3%. What is the recent activity telling us about management conviction?
We check the insider transactions meticulously. In recent months, there has been negligible open market buying by the CEO or CFO,
Which isn't a great sign.
Ideally, we would like to see large cash purchases to signal overwhelming conviction. However, the lack of heavy selling is neutral to slightly positive. Most recent transactions, like those by directors Louis Silver and Peter McManaman, are routine option exercises and tax-related dispositions.
So the real signal of management confidence is the buyback program.
Exactly. Not individual executive purchases.
And what does this high concentration, where the top 25 shareholders own over 73%, do to the stock's price dynamics?
This is the float effect. This concentration drastically reduces the effective number of shares available for trading on the open market, known as the float.
And because the float is reduced,
Even relatively low trading volume can move the stock price significantly. This means higher inherent price volatility, which is a key risk factor for any investor in CEVA.
Chapter 6, Risk Assessment.
Chapter 6, Risk Assessment.
We must invert the thesis now. What are the existential threats that could kill the company or send the stock toward our bear case valuation of $18 to $20?
Let's quickly summarize the core SWOT analysis before diving into the threats.
Go for it.
Strengths. They have dominant IP, validated by that 579 million quarterly shipment base, those fortress 88% gross margins, and a pristine balance sheet with over $150 million in cash and zero debt. Persistent GAAP losses, the small scale that restricts their R&D spending relative to rivals, and the historical volatility of their licensing revenue.
And opportunities.
The massive edge AI explosion, validated by the microchip deal and their recent traction in the high-value automotive ADAS market.
Okay, now, the threats. We have to revisit the single most pressing existential challenge, the ARM bundling threat.
This is a market structure threat. ARM's strategy to bundle their Ethos NPU directly with their ubiquitous Cortex CPUs creates an overwhelming value proposition of convenience.
It's a one-stop shop.
Chip designers are already paying ARM for the CPU, the foundation of their system. By offering a pre-integrated, simple NPU alongside it, ARM provides a one-stop shop solution that minimizes complexity and risk for the customer.
So if a chip designer chooses ARM's bundle, even if CEA's sensor fusion architecture is superior, they are often locked out.
Exactly. For a chip designer to use CE's superior power-efficient sensor fusion architecture, they must actively decide to break the easy ARM bundle.
Which means dealing with two vendors.
And, most expensively, re-engineering their entire software stack to work with the proprietary CEV toolchain. ARM is leveraging its ecosystem dominance to freeze CEV out, forcing the customer to justify the immense switching cost against the technical advantage. This risk cannot be overstated.
And the structural long-term threat remains RICV deflation.
The continued growth and maturation of open-source architectures threatens to fundamentally erode proprietary IP pricing across the entire industry. As RICE ecosystems mature, customers will increasingly have the option to build a good enough processor core for free,
Which puts constant downward pressure on CEV's licensing fees.
forcing them to spend ever-increasing amounts on R&D to stay technologically ahead and justify their premium pricing model.
Let's look at the macro risks. We noted the high interest rate environment with the 10-year yield around 4.14%. How does that hurt a company with zero debt?
While CEV is insulated from direct cost of capital increases, they aren't paying interest expense. The high-rate environment compresses growth valuations across the board. Future cash flows are discounted more steeply when risk-free rates are high, which reduces the present value of CEV's future high-margin royalty streams. This structural pressure makes it harder for CEV to achieve a high price-to-sales multiple, regardless of their operational performance.
We must also revisit the geopolitical uncertainty around the 2025 U.S. tariffs.
Reaffirming the risk. If the signal tariffs of 25 to 100% on semiconductors disrupt global chip production, that will slow down manufacturing volumes.
And since CEVA's royalties are tied to shipments,
Since their royalty volumes are inextricably tied to their customers' physical unit shipments, a global supply chain shock would immediately cause their pharma revenue stream to shrink, potentially derailing the crucial margin expansion thesis.
finally, there's significant China exposure.
This is a major regulatory hurdle. A significant portion of CEV's historical licensing revenue comes from the massive Chinese market.
And U.S.-China friction is increasing.
Increasing U.S.-China trade friction and export control restrictions, specifically targeting advanced technologies like high-end AI, could severely restrict CEV's ability to license their sophisticated Neutro Nano cores into that crucial, fast-growing market. This regulatory risk could effectively cut off one of their key projected growth avenues.
Chapter 7.
Conclusion.
Chapter 7. Conclusion.
We've stripped away the noise, analyzed the financials, and factored in the existential threats. Let's synthesize the final findings and define the definitive bull case.
The bull case rests on the belief that CEV is mistakenly priced by the market as a stagnant legacy business, ignoring the hard evidence of a massive, ongoing AI inflection point.
The key 3 data is the validation.
AI licensing hitting 1/3 of the mix. That's what the market needed. They have a massive foundation in their 579 million quarterly unit shipments that provides royalty resilience.
So if Neutro Nano becomes the standard, if the specialized Neutro Nano cores become the necessary low-power standard for TinyML and Edge AI microcontrollers, the subsequent high-margin royalty explosion in 2026 and 2027 will lead to both rapid earnings growth and multiple expansion.
And that's the asymmetric opportunity.
A classic small-cap growth kicker.
And what is the bear case, the ultimate counter-argument that short sellers are betting on?
The bear case argues that CEE is ultimately a superior feature, but not a sustainable product. They believe ARM's bundling strategy is too convenient, too effective, and the switching costs are too high for customers to absorb.
They also point to the gap losses.
And the persistent gap losses, the extreme volatility of licensing revenue, and the flat revenue history, concluding that the AI hype will not translate into sustainable profit, and the company will eventually be marginalized by cheaper RICV alternatives.
Let's bring it all back to the intrinsic bottom line, the valuation summary.
Based on our rigorous DCF analysis, integrating the necessary projected AI growth vector, our estimated intrinsic value range lands between $30 and $35 per share.
And compared to the current price of $22.90,
this implies an undervaluation of between 31 and 52% if the management executes successfully on their AI pivot.
this leaves us with a final outlook that is cautiously bullish.
Absolutely. CEVA offers a rare combination. A Benjamin Graham-style protected downside, over $150 million in cash, zero debt, and a sticky legacy royalty stream providing resilience.
Paired with a Philip Fisher-style growth kicker.
Paired with a Philip Fisher-style growth kicker on the edge AI revolution. For the highly conservative investor, the gap profitability hurdle is real and the stock will remain volatile.
But for the informed learner looking 3 years out,
The current price offers a significant margin of safety against a highly viable, validated growth narrative. If you believe, as many industry experts do, that the future of AI must move from the centralized cloud to the local device to physical AI, then CEVA is positioned as the essential pick-and-shovel stock to benefit from that structural shift.
And that leads us to our final provocative thought for you to mull over as you finish your research. We've established definitively that CEVA's technology, their specialized sensor fusion architecture, is technically superior in terms of power efficiency and silicon integration compared to the competition.
Right. So the single question that determines the fate of this stock is this. Will that highly specialized, power-efficient, single-core architecture be compelling enough to convince the massive, risk-averse chip design world to overcome the simplicity, the convenience, and the existing software ecosystem lock-in that ARM Holdings offers through its standard-setting bundling strategy?
Because the success of CEVA hinges entirely on the weight of that technical advantage outweighing the cost and complexity of switching ecosystems.
That's the whole game.
It's a fascinating high-stakes technological battle playing out right now in the silicon that literally powers our world.
It really is.
If you found this deep dive insightful and want more analysis like this, like and subscribe to Stock Analytics AI.
And finally, a necessary reminder for all our learners.
This analysis was generated by an AI system for educational purposes and should not be considered financial advice. Please conduct your own research or consult with a qualified financial advisor before making any investment decisions.